The $300 million milestone. Aave V4 deposits across Ethereum and Avalanche reached $300 million this week, just 9 days after the protocol launched its first multi-chain expansion on Avalanche. This surge in capital follows the March 30th debut on Ethereum and signals a fundamental shift in how decentralized credit is structured. The protocol is no longer operating as a single monolithic pool, and the speed of this expansion suggests that the market is finally moving past the fragmentation issues that hindered previous versions. Architecture of the hub and spoke. The core engineering shift in version 4 replaces the traditional lending pool with a hub and spoke architecture. In this design, a central liquidity hub acts as an immutable vault and accounting ledger, while modular spokes handle all user interactions and specific market risk. Instead of every asset sharing one giant risk bucket, each spoke is granted a discrete credit line by the hub. This allows governance to launch experimental markets or niche collateral types without risking the core liquidity of the entire protocol. If a specific spoke faces a liquidation crisis or an oracle failure, the damage is capped by its predefined credit limit, protecting the broader reserve. This separation of liquidity management from market logic is a significant departure from the peer-to-pool models of the last 5 years. It essentially turns the protocol into a central bank that issues credit lines to various specialized branches, stable vaults, and fixed yield mechanics. On July 13th, the protocol launched its stable vaults infrastructure, introducing a dedicated mechanism for fixed-rate stablecoin yields. These vaults are designed as a wholesale layer for fintech integrations, offering a stated fixed rate of 8.75%. Unlike variable rate markets that fluctuate with every trade, these vaults utilize the new reinvestment module to deploy idle protocol liquidity into low-risk yield strategies, such as short-term treasuries. This is paired with a 3-tier risk premium system that prices credit based on collateral quality. For example, a user borrowing against blue-chip assets like wrapped Bitcoin pays a lower premium than one using more volatile tokens. By isolating these fixed-rate environments into their own spokes, the protocol can offer predictable returns to institutional partners without exposing retail lenders to the complexities of treasury management or cross-chain rebalancing. The part no one wants to say. Aave is effectively abandoning its identity as a consumer lending application to become the baseline plumbing for on-chain credit infrastructure. By decoupling the liquidity hub from user-facing spokes, the protocol has solved the primary engineering bottleneck of previous versions: the need to bootstrap liquidity for every new niche market or risk tier. The July 13th launch of Stable Vaults confirms this shift, moving the protocol into the role of a wholesale yield supplier for traditional fintech firms that do not want to manage smart contract complexity. For developers and fund analysts, the relevant metric is no longer just total value locked, but the utilization rate of these internal credit lines. If the spoke-to-hub draw rates remain high without triggering the protocol's new risk premiums, it validates the design's ability to safely export liquidity to specialized environments. The next major stress test will be the integration of the cross-chain savings vault and its impact on the GHO stablecoin's peg stability under the new Anchor module. Subscribe for more